Hello students. In the previous two parts, I was continuously talking about partners capital or current account. Now why I was writing partners capital or current account? In this part we are going to discuss about it. Now in my partnership, the capital accounts of a partners are of two types, fixed and fluctuating. So in the question, either it's given as fixed or it is given as fluctuating. So when it is fixed capital, the capital that remains unchanged. Capital remains unchanged, which means that original capital introduced by partner in business should remain unchanged except additional capital introduced or withdrawal from business. So in a fixed capital, the capital remains unchanged until additional capital is not being introduced in the business or withdrawal of capital from business. So in a fixed capital, we used to make two accounts. Two accounts are being prepared, that is capital and current are being maintained by each partner. So when we are maintaining two accounts, so when we are making a capital account, when we are maintaining partners capital account, so when we are making partners capital account, the partners capital account will always show a credit balance and will always appear on the liability side. In the balance sheet. Other transactions such as interest on capital, salary, drawings, etc. are recorded in the current account. So as a result, the balance of current account keeps on fluctuating, whereas the balance of capital account will always remains constant until an additional capital is not being introduced or withdrawal of capital is not being done. So in a fixed capital account, we used to maintain two accounts, that is capital and current account. So I'm going to tell you the format of fixed capital when we are maintaining. So we have used to perform two accounts. First we used to make partners capital account. In a partner's capital account, for example, we have two partners, A and B. We can show both the partners' account in a single account by making the columns. So, particulars A, B, particulars A, B. So, the partner's balance used to bring on the credit side, that is by balance brought down, that is the balance amount which is to be written over here. If any additional capital is being introduced, so by cash or bank account, if any additional capital introduced, if there is any withdrawal, so it will be written on the debit side to cash or bank account, that is withdrawal of capital. And once to balance it up, when the debit side is lesser than the credit side, it will be balanced up to balance carried down, which will be written on the debit side. So this is how the partner's capital account is being maintained. And partner's current account, it will second account is being made, that is partner's current account, where all the other informations are being shown. The partner's current account, partner's current account. On the credit side, whatever is being received by the partners, it will be written on the credit side, such as by interest on capital, by salary, by commission account, and if there is a profit, by profit and loss appropriation account. On the credit side, if any drawings are being there, so two drawings. If the interest is paid on the drawings, so two interest on drawings, and then the balance. When the credit side is more than the debit side, to two balance carried down. So this is how the fixed capital account is being made when there are two partners. So in a fixed capital account, we used to make two accounts. Hope you are able to understand the fixed capital account. In the fluctuating capital account, now second type we have fluctuating capital. In this method, only one account, such as capital account of each and every partner, is prepared, and all the adjustments such as interest on capital, interest on drawing, additional of capital, withdrawal of capital are recorded in this account under this method. Whereas in fixed capital account, we should prepare two accounts, that is partner's capital and current account. But in the fluctuating, only one account is prepared, that is partner's capital account, and all the information regarding the partners are being shown in this account. Now the important information is this: in the absence of any information, whether we have to make, if it is not mentioned in the question that we have to make the fixed capital account or fluctuating, then you have to make only on the basis of fluctuating capital account, and you have to prepare the capital account on the basis of this fluctuating method. Now, how to prepare the partner's capital account? Now, we have already told you that fluctuating capital account has only one account, that is partner's capital account, and the partner's capital account is a combination of partner's capital and current account of the fixed account. So first we will write down the balance credit side. buy balance brought down, whatever this. So if you have brought additional capital to buy cash or bank account, that is your additional capital. Or if we have withdrawn, it will be on debit side, that is to cash or bank, that is withdrawal of capital. If we have done any drawings, it will return on debit side to drawings account. If we have given interest on drawing, to interest on drawing account. If we have received interest on capital, it will be written on the credit side by interest on capital. Salary or commission, to by salary account or by commission account. And if we have received the profit, so by profit and loss appropriation account. Then you will make a balance. Debit side, credit side is more than, when the credit side is more than debit side, so you write down to balance that is carried down on the debit side. This is how the fluctuating capital account is being prepared. Calculation of interest on capital. Now, interest on capital is calculated on opening capital if it is given in the question. Next, interest on capital should be calculated in proportion of time. If any reluctant information is given in the question. And next, whenever opening a capital is missing, then we have to calculate opening capital by using the given formula. Now this formula is generally being based on fluctuating capital account if we are making on the basis of fluctuating. So how you are going to prepare? So particulars rupees. How to calculate the opening capital on the basis of fluctuating? See, first write down the closing capital. Then what are the things to be added up? Add drawings if any drawing is being done. Then add any withdrawal of capital, that is withdrawal of capital, interest on drawings, share of loss if any loss is being done in the profit and loss appropriation account. And what other things should be subtracted? Less additional capital, interest on capital, salary or commission, and share of profit. This will help you to find out the opening capital, on which we are able to calculate interest on capital. So this is how interest on capital account is being calculated. It is calculated always on the opening capital if it is given in the question. Any information relating to the proportion is being given on interest capital, that is to be used, and whenever opening capital is missing, then we have to use this formula to calculate the opening capital. Now moving to the next part, that is we are going to do a question on interest on to calculate profit and loss appropriation account, and I'm going to tell you about how to manage if the fixed capital account is being made for the partners or fluctuating capital account is being made if it is being mentioned. Now let's start with a question. A and B started a partnership business on 1st Jan 2019. They contributed rupees 3 lakh and rupees 2 lakh respectively. It means that A contributed rupees 3 lakh and B contributed rupees 2 lakh. The terms of partnership agreement are as given as under. First, interest on capital is to be allowed at the rate of 7% per annum. Second, B is to get annual salary of rupees 10,000. Third, the drawings of the partners were rupees 23,000 and rupees 20,000. Fourth, interest on drawings being rupees 2,500 and rupees 1,500 respectively for A and B. And fifth, the profit for the year ended 31st December 2019 was rupees 1,56,000. Now we have to prepare a profit and loss appropriation account and also the fixed and fluctuating capital account. So in this question, I'm going to prepare a profit and loss appropriation account, and I'm also going to tell you if it is written fixed capital, then how we are going to prepare the partner's capital account and current account under fixed, and if it is fluctuating, then how we are going to prepare partner's capital account. So let's start with it. First, profit and loss appropriation account. For the year ended 31st December 2019. So by profit and loss account, how much it is given? That is rupees 1,56,000. Now first point that is to be written as per agreement, that is to interest on capital account. So A will receive rupees 3 lakh. On 3 lakh, how much rate of interest? 7%. That will come as rupees 21,000. And B will receive 2 lakh, on which 7% rate of interest being given to him, that is rupees 14,000. So total 35,000 is being paid as interest on capital. Then B is going to get a salary, the 2 salary account. Who is going to get? B, that is rupees 10,000. Then interest on drawing is being paid by the partners. So by interest on drawing account, A paid rupees 2,500 and B paid rupees 1,500. The total, that is rupees 4,000. And now, so nothing else is mentioned, so we're going to balance it up. Credit side is rupees 1,60,000. Debit side should also have 1,60,000. Now, how much I have already given? That is rupees 35 plus 10, 45. So if we remove out 45,000, it will come as 1,15,000. Now 1,15,000 is being the profit for to be distributed among the partners. In which ratio? The ratio is not being given over here. So if the ratio is not being given, so as per Indian Partnership Act, it will distribute it equally. So two partners, two profit transferred to A's capital or current account. Still I am writing because we are to make both. 57,500 A will receive and B capital or current account, that is 57,500. Total it will be 1,15,000, which will make the debit side equal to the credit side. So this is how we are going to prepare the profit and loss appropriation account. Now first I'm going to make, if I have to make fixed capital account. So fixed capital account, in fixed capital account we used to make two accounts, that is partners capital account. Now we have two partners, A and B. Now nothing is being mentioned whether related to additional or withdrawal. So if nothing is being mentioned, so there will be no change in the partners capital account. It remains fixed in the case of fixed capital account. There will be no change as there is no withdrawal or addition. So by balance brought down, A has rupees 2 lakh and B has rupees, A has rupees 3 lakh and B has rupees 2 lakh, and the balance remains, that is 2 balance carried down. A has rupees 3 lakh and B has rupees 2 lakh, which is being brought by A and B as in the form of capital. So it will be balanced up. Then partners current account. So partners current account, the rest of the information which is being given, that has to be shown in the partners so the interest on capital is being received by both the partners. So by interest on capital account, how much A has received, that is being rupees. A has received 21,000 and B has received 14,000. Then by salary, A has received a salary of rupees, B has received a salary of rupees 10,000, A has not received it. Then the drawings is being made by both the partners, so it will be written on the debit side. To two drawings, A has withdrawn rupees 23,000 and B has withdrawn rupees 20,000. Then the interest on drawing, to two interest on drawing, that is A has withdrawn, interest paid 2,500 and B has paid 1,500, and both A and B has received the profit and loss profit. A has received 57,500 and B has received 57,500. Now we can find out that debit's credit side is more than a debit side, so we have to balance it up. So when we will balance it up, add up the credit side balance, which comes as for A it will comes as 78,500 and for B it comes as 81,500. Then it should be 78,500, 81,500. So we subtract it up, 25,500. So A's balance is 53,000 and B's balance will be that is 60,000. So in the balance, this is how the fixed capital account is being made. Now coming to the fluctuating, if it is being, we have to make the fluctuating, as the question states that we have to make both, so we are making it both. Fluctuate, if the question asks to make a fluctuating capital account, so in the fluctuating capital account we used to make only one account, that is partners capital account. So if it is mentioned fixed capital account, we have to write down in the profit and loss A's current account or B's current account. If it is mentioned fluctuating capital account, then we have to write down A's capital account or B's capital account. So in the fluctuating capital account, we have to make only one account, that is partners capital account, which contains all the information of a partner. So generally a combination of fixed and fluctuating capital and current account of fixed capital account. So first, buy balance brought down. A's balance is rupees 3 lakh and B's balance is rupees 2 lakh. Then buy interest on capital account. A is 21,000, B received 14,000. Then buy salary. A hasn't received, B received 10,000. Then buy profit and loss appropriation account. A received 57,500, B received 57,500. On the debit side, two drawings. A withdrawn 23,000, B 20,000. Two interest on drawings. A paid rupees 2,500, B paid rupees 1,500. So we will balance it out. A's balance will make a balance, debit side and credit side. A's balance is rupees 3,78,500 and B's balance is 2,81,500. Now on the debit side should also come as 3,78,500 and 2,81,000. After subtracting the debit balance, it will give you two balance carried down, which will be carried down. So A has a balance of rupees 3,53,000. A has a balance of rupees 3,53,000 and B has a balance of rupees 2,60,000. This will be the required answer. Thank you.